Imagine the exact second the non-farm payrolls report hits the wire. A central bank chairman steps to a podium to announce a shift in global economic policy, and institutional algorithms react in milliseconds. The chart explodes. You watch a currency pair like the UR/USD surge 80 pips in 3 minutes. Fear of missing out kicks in, and retail traders aggressively buy the breakout. Then the trap springs. That surging price hits an invisible wall. It violently retracts, leaving behind a long wick, and begins a slow, agonizing descent back down, wiping out all the late buyers. The rubber band effect governs these moments. Sudden price discovery stretches a market far from its historical average, building mathematical tension. Eventually, the buying pressure exhausts itself, and the market's statistical pull toward the mean begins to take over. Chasing that initial news spike is a pure gamble. The professional edge lies in trading the aftermath, calculating the exact moment that structural tension breaks to capture the high probability return toward equilibrium. This diagram illustrates a standard distribution bell curve. In a normal market, price action stays within this shaded central zone, one standard deviation from its average, about 68% of the time. When high-impact news hits, it forces the price deep into the margins. A z-score measures exactly how many standard deviations we are from the historical average. If a price spike reaches a 3.0 z-score, it sits in the top 0.1% of historical extremes. The market is completely overextended. To see this math on a live chart, we use Bollinger Bands. This visual shows those standard deviations wrapped around actual price action, creating dynamic boundaries that expand as volatility increases. But high volatility news can cause Bollinger Bands to rapidly distort, generating false signals. By layering Keltner channels, which calculate boundaries using the average true range instead, we create a smoother, more stable envelope. The gap between the chaotic Bollinger Band and the steady Keltner channel creates a distinct exhaustion zone. Combining these two channels allows traders to visualize the exhaustion zone between dynamic volatility and the smoother average true range, marking the areas where price momentum frequently stalls. Timing your entry requires discipline. You have to wait 30 to 60 minutes after the initial news release. Let the institutional algorithms finish their chaotic price discovery. Never short a market just because the price taps that outer boundary. Doing so traps you in a phenomenon called band walking, where a strong trend simply hugs the outer limit as it climbs higher and higher. This split chart shows how we spot a dying engine. On a 15-minute time frame, you want to see the price pushing to new highs, while the RSI indicator makes lower highs. That divergence signals the buying momentum is hollow. The absolute trigger to enter the trade happens here. You wait for a single 15-minute candle to close completely back inside the volatility channel. The extreme momentum is broken. Once that tension breaks, market gravity takes over. Notice this line appearing below the price, the 20-period exponential moving average. It acts as an immediate dynamic mean, pulling the overextended price back toward the center. For massive 150-pip price voids, the pull extends even deeper. Long-term gravity will drag the market all the way back to its ultimate home base, the 200-period simple moving average. Waiting for RSI divergence and targeting these specific moving averages separates amateur gambling from professional execution. You stop catching falling knives and start trading highly probable mean reversions. Even with the statistical odds in your favor, a standard tight stop loss will ruin you here. The post-news cooling period is notorious for secondary volatility spikes that easily wipe out tight stops. This graphic shows how to properly protect your position using dynamic risk. Instead of a fixed number, use the average true range to create a buffer zone. Place your stop loss 1.5 to 2 times the ATR above your entry, keeping it safely outside the 3.0 z-score extreme. Once you are safely in the trade, apply the 70-30 exit strategy. Your objective is simply to ride the return to the mean, not to blindly predict a complete market trend reversal. Target 1 is the 20 EMA. The moment the price touches this moving average, you secure 70% of your profits. You have immediately covered your risk and banked a clear win. For target 2, move your stop loss down to your break-even point. Now let that remaining 30% position run risk-free toward the long-term 200 SMA magnet for maximum potential gain. Mastering the snapback strategy means you stop reacting to emotional green candles and start calculating a statistical return to reality. To execute this with precision, take advantage of FXNX's 0.0 pip spreads. Download our mean reversion checklist and deploy the NX volatility scanner today to find your next high probability setup.